The other thing that I'm thinking about is, okay, and everybody wants to know, none of us know, we don't have a crystal ball, when this cycle peaks. And a lot of people have PTSD from 2021 because the business cycle and liquidity peaked in March. Why? Because 2020 was that massive fall in the business cycle, massive stimulus. It was just a completely squashed cycle. Now, if I look at it, if I look at the business cycle, the ISM survey still below 50. We've barely started going up. So it feels that the probability is this cycle plays into the end of the year or even into Q1 2026. And that's a tail risk. I think the market's going to struggle with this. If I'm right, people are going to get out of risk too early and they're going to be forced back in at the end, and you get that 2017 final explosion.
In recent weeks, Raoul, CEO of Real Vision and former Goldman Sachs exec, has shared his belief that the current crypto bull market could extend into early 2026. He highlights the importance of global liquidity in driving crypto markets, noting that periods of increased liquidity, which he calls crypto macro summers, historically lead to significant gains in crypto and tech assets. Powell suggests that central banks cutting interest rates and potential fiscal stimulus will help fuel the next phase of the bull market, possibly peaking in late 2025 or early 2026. Despite current bearish sentiment, he believes improving financial conditions and liquidity could spark a resurgence in crypto, similar to the post-2017 recovery. Powell discussed these insights in a conversation with Joe McCann, founder of Asymmetric Hedge Fund, which posted a 202% gain in 2024.
At the beginning of this year, I was actually, for the first time in a long time, tactically bearish. And I know you know what that means. It does not mean that all of a sudden I think the top is in and that, things are going lower. It's just that there was this confluence of odd events, which I know you recall on December 18th with the Fed. And what transpired after that was just a collapse in not global liquidity, but liquidity in the markets, right? We saw massive amounts of liquidity just effectively dropping out of the order books, not only in crypto, but also as it related to the stock market. We saw fixed income yields continue to push higher, which means bonds were selling off. We saw the day of the Fed cutting 25 basis points, the dollar rises. I mean, these are fundamentally things you don't assume will happen, and let alone the VIX spiking 74% the day of the Fed, which was the second highest VIX spike ever. I was looking at this going, everybody's really bulled up right now, right? And yet the market is telling us something slightly different. And so we managed throughout the end of the year, like I said, we had a great year. But for the first couple of weeks of January, frankly, we were short and in cash because we just felt like, look, number one, as you pointed out,
you actually went net short, or were you?
Yeah, well, barely, not much, right? And this is all through fixed risk, right? So we put on some put spreads that were basically a 30-to-1 payout, and if they worked, great. It protects the book. We were heavy in cash. I mean, we still had some kind of, you call it January, Feb, March Bitcoin option structures on. So we did have some exposure in case we were wrong and the thing actually ripped. But we just didn't feel strongly that the first couple of weeks, given what had happened the last 2 weeks of 24, were, an obvious long. And we didn't see a bunch of new flows come into the market. And in fact, our view was correct that Bitcoin effectively cracked 90K, went down to 89K, and then just ripped straight up. So we are full bull again. And a lot of that has to do with the macro picture, right? So, you and I, of course, big disciples of global liquidity. There was obviously a break in correlation in Q4 that was largely the idiosyncratic move around President Trump and his win and, frankly, the red sweep. Because we saw Q4 on a notional basis was actually detracting a little bit from global liquidity, but that doesn't imply that the cycle is over. So we still are of the belief that at some point in 2025, we will likely reach some sort of top in global liquidity. That does not imply that Bitcoin is done. It just means that we're getting close. And so my view for the year, based on the information that I have today, is I really feel Q1 is going to be the strongest quarter for risk assets in general. Q2, Q3, I don't want to say I'm bearish, but it's going to be more difficult. Q4, I think we have the opportunity for a rally again. And a lot of this stems from the fact that the S&P 500 had back-to-back 20% plus years It's very difficult to replicate that for a third year in a row. It's not impossible. We see a lot of the headlines now, especially with Trump in office, hundreds of billions of dollars being invested by the Saudis, hundreds of billions of dollars being invested in Stargate, which is the AI infrastructure play. CapEx investments across corporates right now is huge. A lot of this driven by the AI boom. But as it relates to crypto, the sea change shift in sentiment around policy, I think, is actually one of the most bullish tailwinds. I'm sure we'll talk about the strategic Bitcoin reserve, but for me, the bigger thing is SAB 121 getting repealed. That's the staff accounting bulletin that the SEC put out that functionally makes it impossible for banks to hold crypto on their balance sheets because they have to count them as liabilities. That going away, and I know you know this as a former banker or working at the banks, unlocks a huge amount of potential for crypto within not only consumer banking, but frankly on the institutional side and the investment banking side.
Yeah, I mean, I've got a very similar view. Is, I think global liquidity leads and global financial conditions lead that. For me, it looks like we will see the turn. We really need the dollar weaker, which it looks like it's starting to do. And that should pick us up. We know that the Treasury is going to start draining the general account. Reverse repo, last bit of draining of that. They'll probably have to stop QT. Then there's probably a few more rate cuts to come in. I think the market has underpriced rate cuts now, having overpriced them earlier.
The fact that our view really is that we think there's still 4 cuts. We think the Fed funds futures market is wildly mispriced at this point, right? And furthermore, I think reverse repo dropped below $100 billion this week for the first time in a long time. The Fed is going to have to end QT, right? Now, one other thing that we're looking into that we think is potentially a huge tailwind is that the Fed could potentially drop the reg caps on treasuries, effectively enabling banks to go to 0% on those and buy an infinite number of treasuries, right? So of course they will. And this is, I think this is, I know you know this, but we want to share with your watchers and listeners that these are tools of the Fed that a lot of people don't tend to focus on. Yes, they know about QT and QE. Great, that's understood. But there are other aspects that they can lever to actually improve the broader liquidity, calm the Treasury market. I think Bessent's going to do a fantastic job as Treasury Secretary. He's a really sharp guy, understands global macro dramatically, especially FX. So to me, the concerns around is the 30-year going to 10%, this nonsense that I keep hearing, it's just not going to happen. They still have a lot of tools at their disposal to make sure that the markets are actually functioning and flowing properly.
Yeah, the other one that's coming in that is below people's radar screen. It's starting in Europe as we speak, which is Basel IV, which is yet another version of banks are going to hold more bonds. It's all the same thing, right? Which is QE, not QE, which is will force the system to own these bonds, and then we don't have to buy them ourselves because QE is now a dirty word. So they'll do anything not to do QE unless they have to.
Yeah, and I mean, look, I think for us, I think we wrote about this back in October of last year. China is still a huge component of this, right? I mean, their economy is not looking great is the diplomatic way of putting it. I mean, they have a major internal demand problem, domestic demand. As you're aware, their 10-year yields are hitting new all-time lows. It seems like every week. It's just the chart is horrendous. Something has to give, and I do think that there is some potential, Jedi mind trick stuff happening between Xi and President Trump that will likely, come to fruition at some point this year. That to me is another massive tailwind that is radically mispriced.
Raoul Pal and Joe McCann highlight that among G20 nations, China's People's Bank injected the least liquidity last year. They believe even a partial return to normal liquidity levels could significantly impact markets, which have yet to fully account for this. However, China's ability to stimulate is limited by the strong US dollar, which some view as a strategic move by the US to pressure China into negotiations. Powell predicts the US may agree to a weaker dollar in exchange for trade or geopolitical concessions, similar to the 2017 dynamics under Trump. As global liquidity is expected to rise, they speculate on its potential impact on top cryptocurrencies like Bitcoin, Solana, and Dogecoin.
The other thing that I'm thinking about is, okay, and everybody wants to know, none of us know, we don't have a crystal ball, when this cycle peaks. And a lot of people have PTSD from 2021 because the business cycle and liquidity peaked in March. Why? Because 2020 was that massive fall in the business cycle, massive stimulus. It was just a completely squashed cycle. Now, if I look at it, if I look at the business cycle, the ISM survey still below 50. We've barely started going up. So it feels that the probability is this cycle plays into the end of the year or even into Q1 2026. And that's a tail risk. I think the market's going to struggle with this. If I'm right, people are going to get out of risk too early and they're going to be forced back in at the end, and you get that 2017 final explosion. That's kind of my working hypothesis now.
Yeah, and I mean, look, one of the things that we're also tracking that I don't think gets a lot of airtime is the credit cycle. I mean, the banks are actually highly incentivized and positioned to start lending pretty dramatically. This should continue to be a tailwind of the business cycle, as you're describing. And I do think, the PTSD, certainly in crypto, is warranted to some extent. But it's just such a structurally different environment, right? You have, the Fed funds rates still close to 5%. Real rates are still incredibly restrictive. They got a lot of room that could potentially cut. And you saw the CPI print recently. This implies PCE has been targeting towards 2% for almost 6 months now. Anything can happen, but the trend is clearly lower. You'll have these kind of idiosyncratic spikes in CPI and PPI, but ultimately the Fed is actually tracking towards their 2% inflation target. And with the boomer of the NFP print that we saw, a couple of weeks ago, granted we will of course see this modified over time, it feels like the Fed still has the ability to cut. And so if you take looking at like the credit cycle, the business cycle, peaking in March just seems low probability. And I do agree with you. I think people are actually underexposed to the right tail at this point of a massive economic boom. I mean, if you see what's even happening geopolitically in the Middle East, you see Saudi Arabia, I think there were something along the lines of a $600 billion investment in the United States. People are coming to the table, with gifts for the president, effectively saying like, we want to be part of this larger economic boom. I struggle to see a situation where somehow this is done in Q1 of this year.
And also, core inflation is driven by rents. Mm-hmm. Rents are deflating. The forward-looking stuff is now negative, but rents are also a function of mortgage rates. So as rates come down, that core comes down. So I think the Fed had much more cover than people understand. Again, people have PTSD from last time. They stick up the chart of inflation versus the 70s and say, see, this is going to happen all over again. I'm like, no, it's not. It's not even close.
Yeah, and I mean, look, if you look at equities as well, I think the most bearish case that I've seen from any of the investment banks' sell-side research teams at this point is valuations. And I don't even think they're that stretched at this point. But more importantly, I mean, yes, Mag 7 has continued to really outperform. We're starting to see signs of breadth improving. If you just look at like the Russell as an example, since Trump came to office, it's done extremely well. These are all net positive longer term for the broader economy, especially as you look at small caps, because these are the folks that are super interest rate sensitive, right? Because if you're, Apple or Google and you've got tens of billions of dollars in your corporate treasury, park them in T-bills. You love high interest rates. But if you're, a small automotive manufacturer in, rural Ohio, you're borrowing to fund your business. And so I think part of the challenge with looking at the future for rate cuts, with people saying like, they're done for the year, or there's only 25 bips price or something, it just doesn't make sense, especially as you look at what's happening in the broader economy.
Yeah, we've got two economies and people can't see it. One is driven by liquidity, which is the tech stocks, and all the others live off debt and earnings. And if you ask the average business across anywhere in the United States, they're not seeing a boom time yet because the ISM survey is below 50. So we've got two different forms of economic growth, and half of the growth that we got right now is the kind of pre-election goosing of tax and other stuff. that's happening. So it'll work its way out. The economy will slow down. The Fed will get more aggressive, is my general view. So given this, we broadly agree, and again, we don't have a crystal ball, but we broadly agree. So let's talk about asset allocation at top level. From my perspective, as the ISM survey picks up, in fact, when it crosses 50, is pretty much the perfect signal for alt season. So you might have been playing Bitcoin call options last year, but how are you thinking of this year I mean, you were a big Solana holder and other stuff as well, but what do you think your asset allocation strategy is going to look like? Right now? I mean, obviously it can change, but...
I'm going to respectfully disagree short term with you on alt season.
Yeah,
and
that
here's
could be true, yeah.
And part of the reason is that, like, I've had a view for quite some time that I don't think Bitcoin dominance has actually topped. I think it actually still has some room to run. This doesn't mean that certain alts won't actually rise. It just means that it's not a true alt season until you see a complete, kind of reversal in Bitcoin dominance. That being said, the alts that we are actually looking at, I mean, the size of our fund, we can't be in the trenches with the degens, so to speak, right? But I do believe that if you look at, obviously things like Solana, right? Like, let's just call it what it is. Trump launched his meme coin 3 days before his election, or inauguration, I should say.
We'll come back to that later.
Yeah, we will definitely come back. But if you look just fundamentally what happened on Solana, hundreds of thousands of new people onboarded, records amounts of trading volume on DEXs, record amounts of tips on Jito, which is a service that you can utilize to land your transaction faster. I mean, it's very difficult for me to still see a scenario where either A, Solana should remain 1/3 the value of Ethereum, or B, any of the high performance, high throughput chains can currently catch Solana.
Joe McCann looks beyond technical blockchain fundamentals when trading, adding exposure to promising projects like Sui for extra beta in a Solana-focused strategy. He's also bullish on meme coins, which he sees as a serious asset class in 2024, with Dogecoin outperforming Bitcoin, Ethereum, and Solana due to Elon Musk's influence, the election cycle, and meme culture. Both Powell and McCann believe the launch of Bitcoin and Ethereum spot ETFs is just the start, with a Solana ETF and eventually meme coin ETFs, like Dogecoin, on the horizon. Powell is particularly excited about a Dogecoin ETF, predicting it could attract $30 billion. They remain very bullish on crypto prices in 2025 and beyond, saying the bull market is just getting started. Do you agree that the cycle could extend into early 2026? Share your thoughts below.